Hello everyone, a very good evening. So this is the first lecture of our BRBL capsule batch for the December 2025 exam cycle, and today we'll be covering our module A. We'll be revising our first module. So once you are here, just mark your presence and the notes that you'll see here, these are very crisp. Everything is covered, all the important points are there, but just focus on the explanation once, right? First, focus on the explanation. You can download these notes for your revision later on as well. Use these notes only for your revision. All right. So, this class is going live on the paid platform as well as on YouTube. Those who have joined on the YouTube, I'm watching the comments. So if you have any doubts, any queries, you want me to repeat any topic, please let me know. And those who are here on the paid platform, good evening, good evening. So let us start then. If you have any doubts, any queries, any topic you want me to repeat, please do. So the first unit of our module A, which is the legal framework for the regulation of banks. Here, two acts are covered in the module A. Banking Regulation Act of 1949 and the Reserve Bank of India Act of 1934. So we know these two acts, they govern the banking in India. RBI is the regulator, the controller of banking system. Some powers have also been given to the government, like the opening of the bank. RBI has the powers, winding up of the bank. Some powers are given to the government for the acquisition, amalgamation. However, if any entity, if any entity wants to start the banking business in India, what do they require? They require license from RBI. Without getting a license from RBI, they cannot start the banking business in India. Okay, what is the banking business? It is defined under the section 5B of our Banking Regulation Act. Two things are compulsory: accepting deposits of money from the public, only money deposits are accepted. Any goods cannot be accepted by the banks. Then these deposits should be repayable on demand or otherwise. These deposits, they can be demand deposits, they can be time deposits. Banks are the only entities that are allowed to accept the demand deposit. They can be withdrawable by check, draft, or any other manner. Like electronically, also they can be deposits. So these deposits which are accepted by the banks, demand deposit or the savings deposit, these are used to create loans. These deposits can be repayable on demand or after a period of time. When they are accepting the deposits from the public, banks, they need to consider the fit and proper criteria. They need to do the KYC, the anti-money laundering norms have to be followed, and only then they will accept these deposits from the public. Right? Similarly, for giving loans also, this due diligence has to be carried on. Okay, for the customer identification. Now, when the deposits are accepted by the banks, deposits that are accepted by the banks, they are regulated by the section 49A of the Banking Regulation Act. Only banks, RBI, SBI, or other entities, they are allowed to accept those demands which are withdrawable by check, that is, demand deposits. Other entities like NBFCs, they can also accept deposit but not withdrawable. They are time deposit or under a special scheme. So the acceptance of deposits by the non-banking entities, these are regulated by the RBI Directions of 1998, Chapter 3B, RBI Act. And obviously the KYC norms, AML norms, all of these have to be followed. Then license, I told you, every banking entity, when they want to commence the banking operation, they want to start the banking operation in India, they first need to apply for a license. They will apply for a license under the Section 22 of the Banking Regulation Act. With whom? With RBI. And RBI also will check the whole fit and proper criteria. They will check, does the bank have the paid up capital requirement? Does the bank have the intact number of directors, and do they have the capacity to pay off all their obligations to the depositors in present as well as future. All of these things will be checked, and then RBI will grant them license. Once they get the license, only then the banking companies will start accepting deposit and giving loans. And then they have to use the term bank, banker, or banking in their name, compulsory. When they start the banking operations, they get the license from RBI. They have to use the word bank, banker, or banking in their name. No individual, firm, or group is permitted to use these words other than the banking company. All right, so these are the regulations. Also, I have included the sections. Only these sections are important for you to remember, nothing else. Then the permitted business, I told you, accepting deposit, giving out loans, these are the basic functions that the banks perform. Under the section 6, the permitted business is given. What you need to remember is the section 8 of the Banking Regulation Act. Banks, they cannot directly or indirectly participate in trading activities. They cannot buy or sell any goods, any tangible goods, not allowed, right? Any kind of movable property. There are certain exceptions, however, exceptions like the bills or actionable claims, stocks, shares, these are exception. Other than that, trading of goods, movable property, not allowed. Okay. If the banks, they do acquire some immovable property, they do acquire some immovable property, they have to dispose it off within 7 years. Now, this can be extended, right? It can be extended further, maximum 10 years, not more than that. They have to dispose of the property, any immovable property. All right, so remember the prohibited business, Section 5(8) of the Banking Regulation Act. Banks cannot trade, buy, or sell directly or indirectly any tangible, movable property. Not allowed. Any such contract will be void. Now in India, there are different categories of banks. Banks can be a body corporate constituted under a special statute, like SBI is there, RRBs are there under the RRB Act. Those companies that are registered under the Companies Act, let's say a private sector bank or a foreign company which is incorporated under, these are the categories of banks in India, right? So the public sector banks, they are created under the Banking Companies Acquisitions and Transfer of Undertakings Act of 1970 or 1980. Is there some connection issue? Is the video fine? The audio and video is fine, right? Okay. Yes. So the public sector banks other than SBI, either under the Banking Companies Acquisition and Transfer of Undertakings Act 1970 or the Banking Companies Acquisition and Transfer of Undertakings Act 1980. These are the nationalized banks. Government took over certain banks, nationalized banks. Then we have SBI, which is constituted under the State Bank of India Act of 1955. And then the seven subsidiaries were also merged with SBI over the period of time. Recently in 2017, RRBs under the Regional Rural Banks Act of 1976. Private banks or foreign banks, they are under the Companies Act. They are registered under the Companies Act of 1956, 2013. Foreign banks, as per their country law, and they should also fulfill the RBI regulations here in India, and a cooperative bank. right? A cooperative bank registered under the Cooperative Societies Act, incorporated under the Cooperative Society Act, and they get registration by RBI. Okay, so these are the types of banks in India. Now, let us discuss about the RBI Act. The RBI Act of 1934. It was enacted to constitute Reserve Bank of India as the central bank. The main purpose to regulate the issue of banknotes, to keep the reserves, to secure the monetary stability in India, the currency and credit system, everything is controlled by RBI, right? RBI gives directions to the banks, the powers, the functions of RBI. All of these are given in the Banking Regulation Act, except for Section 42, which deals with the cash reserves of the scheduled banks. Section 17 and 18, RBI is the lender of last resort. What is the meaning of last resort? Banks can take loans from RBI at repo rate, bank rate. RBI is the whole sole authority to issue banknotes. No other entity can create new notes in India. This is as per Section 22 and Section 30. Government has power to supersede the RBI board in certain exceptions, right? An amendment was made in 2019. RBI has more power over the NBFCs now. Why? RBI to improve the working of the NBFCs. The net owned funds have been increased. RBI can appoint the directors, supersede the board of the NBFCs, debar any auditors. All of these powers have been given to RBI. Okay. Then there were certain other sections like Section 45 MAA. RBI can remove or debar an auditor from acting as an auditor of bank, NBFC. RBI also has powers to frame the schemes for amalgamation or restructuring, splitting of an NBFC. All of these things are there. Okay, so these are the powers given to RBI. These are the things under the RBI Act. Then, if we talk about the Banking Regulation Act, now originally in 1949, when the act was enacted, the name was Banking Companies Act of 1949 because it covered only the banking companies. Then in 1966, the name was changed to Banking Regulation Act because cooperative banks were also now brought under the purview of RBI, the Banking Regulation Act, right? So in 1965, this amendment was done, and in 1966, the name was changed to the Banking Regulation Act of 1949. Before that, it was applicable to the banking companies only. So now it is applicable to the primary cooperative banks, the state cooperative banks, the central cooperative banks as well. Okay, so RBI has regulatory control over the cooperative banks, its management, the capital, audit, liquidation, everything. Okay, so amendment in 2017, RBI is empowered to direct banks to initiate insolvency. 2020 amendment, RBI's power to control the cooperative banks. 2012 amendment, the DEAF, Depositor Education and Awareness Fund, was created by RBI. What is this fund? Wherever the banks, wherever the banks, they have the inoperative accounts, they have unclaimed deposit, they need to transfer it to this DEAF. And then RBI will use it to create awareness campaigns, advertisement, pamphlet to increase the customer awareness. Okay. RBI also has the power to conduct the inspection, the annual financial inspection through the SPARC. If you remember, SPARC. SPARC is there. Supervisory Program on Assessment of Risk and Capital. So all of these things are there. Okay. Now, if we talk about RBI's control over the cooperative banks, there is dual control. The state registrar, who is to make sure of the incorporation. So every cooperative society, They get incorporated under the State Act or the Central Act, the Cooperative Societies Act. And RBI has the power over its regulation. When they are acting as a bank, RBI will issue them directions. Okay. Similarly, there's the Multi-State Cooperative Societies Act for the multi-state banks. Those cooperative banks that are operating in more than one state, they have branches in more than one state. So RBI has powers to supersede their boards, to restructure their boards. They can debar or they can remove a director from the board. They can appoint a new director, a temporary director, additional director. All of these powers are there. RBI also has the powers to protect the depositors. Now, earlier the cooperative banks, they were not allowed to raise capital from the market. Now they are allowed, right? Now they can raise capital. Okay. Then there is mandatory licensing requirement that we have already studied. Now, government also acts as the regulator of banks, right? Government also acts as the regulator of bank. How? Under the section 7. Under the section, just a second. Yes. So under the section 7 of the Banking Regulation Act or the RBI Act, Government of India has been given some special powers. They can give directions to RBI wherever considered important, right? So in consultation with the governor of RBI, the government will give them directions. However, only two types of directions are given, and only once the direction has been given. When? In 2018, right? These directions were related to the NBFCs, to improve the functioning of the NBFCs, and second, to improve the weak banks, their lending to the small and medium enterprises. These were the directions given by the government to RBI. Government also has the power to hear appeals. Whenever RBI, let's say, removes the managerial personnel of the bank, they can make an appeal to the government. The government's decision will be final. Wherever the RBI cancels the banking license, they can make an appeal to the government. Again, their decision will be final, right? Suspension of operation or any other thing. All right. RBI, apart from RBI and the government, there are other regulators of the banks as well. Like SEBI controls the banks. There is IRDAI, there is the mutual fund regulations, the PFRDA. All of these regulators are there. All right. So that is all about our Unit 1. We have completed our legal framework of regulation of banks. This is all that you need to remember. Till here, if you have any doubts or any queries, please let me know. And if everything is clear, then also give me a confirmation. Clear till here? Everything till here is clear? Okay. Now we are starting with the second unit. Again, just listen to whatever I'm saying. Go through the notes later on, you can use it for revision. When we are talking about the control over regulation of banks, who has the control? Again, RBI has the control, starting from the license till it's winding up. Each and every power has been given to RBI. First, license requirement under the Section 22 of the Banking Regulation Act to commence banking business in India. First, the entity needs to apply to RBI. Let's say any company, any bank was already in existence before 1949, before the Banking Regulation Act of 1949. They also had to apply for a license within 6 months from the commencement of the act. And if RBI gives them license, then they can continue. And if RBI rejects the license, they will have to shut down their banking business. All right, so this is the license requirement. Whenever any entity applies to RBI for getting a license, RBI will do the fit and proper criteria, check that whether the banking company they will be able to repay its depositors in present and in future. The affairs should not be conducted which are detrimental to the depositors. Do they have the adequate capital and earning prospects or not? Are they going to do the acts which would serve the public interest? RBI should not grant license to a banking company who will act in a discriminatory manner, in a prejudicial manner, right? So RBI is going to check all of these things and then they will grant the license. All right. Now, Section 11 of the Banking Regulation Act stipulates the minimum capital and reserve requirement of a banking company. RBI has the power to stipulate a higher requirement, right? Whenever the bank applies for the license, by giving the license, RBI can also stipulate a higher requirement. And then RBI, when it is satisfied that the bank has adequate capital structure and earning prospects, then only they will grant the license. Similarly, for a foreign company, they also have to apply to RBI for getting a license when they are setting up their wholly owned subsidiary or a branch in India. They will have to fulfill the prudential supervision in their home country. Then RBI will check the economic conditions between India and that home country should be peaceful, should be good. RBI will check the financial soundness of the foreign bank, the ownership pattern of the foreign bank, the rating of the foreign bank, international presence, and again, they should not conduct anything which can be detrimental to the Indian public, right? So these are the license requirements. Then for universal banks also, now RBI has been granting license to Universal's Bank on tap. Earlier, only windows were open. Only certain time periods were opened when they could apply for a license. Now, on time, stop and go licensing policy is there. Obviously, there are certain amendments in 2013 discussion paper for the way forward. Universal Bank's licensing was created. In 2014, RBI gave license to two universal banks. In 2016, on tap licensing guidelines were given, right? In 2019, for small finance banks and payment banks, for differentiated banks also, the guidelines were issued. Okay, so for universal banks, again, the eligibility of the promoters will be checked, the fit and proper criteria will be checked, the shareholding, minimum voting equity capital requirement, the regulatory framework, all of these things will be checked, right? For the small finance bank also, RBI will check these things, right? The eligibility criteria of the promoters, what is their scope of activities. We will be talking about it in the fifth unit in detail, right? Now, I told you RBI has the power to grant license. RBI also has the power to cancel the license of a banking company, right? RBI has the powers to cancel the license. When will RBI cancel the license? If the company ceases to carry on the banking business in India, they are no longer accepting deposit or giving loans. If they fail to comply with the conditions, let's say RBI had imposed a higher capital requirement on them, they failed to fulfill it, then also RBI can cancel their license. Or at any point when the RBI has said that you need to correct these and these much things, you need to fulfill the CRR, SLR requirement, and they're not complying with it, then RBI can cancel their license, right? Obviously, before the cancellation, a chance to be heard will be given, right? They also have the right, the aggrieved bank whose license has been cancelled by RBI, they can make an appeal to the central government within 30 days, right? Within 30 days. And whatever decision is taken by the government says that yes, the cancellation is correct, the bank should be shut down, it will be followed. Otherwise, if the government thinks a little more time can be given, then it will be followed accordingly, right? So the decision of the central government will be final. No appeal can be made against the decision of the central government. Okay. Now, before starting the banking business, the entities they need to get approval from RBI, they need to get the license. When they are opening a place of business, then also they need to get approval. So, no banking company shall open a new place of business in India or change their existing place of business outside if they want to change their branch in the same city. Let's say they have a branch in Lucknow and they want to shift it within Lucknow. That is allowed. That is allowed. Within the same city, town, or village, they want to open a new place or they want to change the location of an existing place, then it is allowed. Otherwise, they have to take prior permission of RBI. Okay? And there are exceptions to this. If a temporary branch is being opened for less than 1 month, let's say for exhibition or a mela, or there are some in an educational institute, admissions are going on, conferences are going on. For that, for 1 month only, temporary place of business is being opened, then prior approval of RBI is not required. More than that, approval of RBI is important for opening a new place of business, right? Now, RBI, I told you, will cancel the license of the bank if such prior approval is not taken. Okay. Next, if we talk about the Section 11 of the Banking Regulation Act, it talks about the paid up capital and reserves. The paid up capital and reserves. Till here, if you have any doubts before we start the new topic, if you have any doubts, then you can ask. Right? So this again is dealt in detail in the Unit 5, like the foreign banks, if they're having a place of business in India, they have to keep deposited in cash or unencumbered approved security a reserve, an amount of rupees 15 lakh, right? And if it has a place of business in Bombay or Calcutta, 20 lakh rupees. Similarly, the Indian banks also, they have to maintain this paid up capital. Paid up capital requirement is there. If it has a place of business in more than one state, 5 lakh rupees, right? And if that place of business is in Bombay, Calcutta, or both, then 10 lakh rupees. This is more than one state, right? And if let's say it has all its places of business in one state only, and that state that is not in Bombay or Calcutta, then 1 lakh rupees in place of the principal place of business and 10,000 rupees other places. Like this, the paid up capital requirements are there. We will cover it in our Unit 5. Now, let us talk about the shareholding in banking companies. Voting rights of the shareholders. Earlier, the banks were not allowed to raise capital, but now they are. However, although there is no ceiling or limitation on the number of shares that a person can hold, there's no ceiling on a person's holding of share, but there's a ceiling on the voting right, right? Voting right. So, voting right is capped at 10%, which RBI can increase to 26%. And when we are talking about the paid up capital, if anyone is getting shares that make them a holder of more than 5% of the paid up capital, then they need to get RBI's approval. Prior approval is mandatory if someone is acquiring more than 5% of the paid up capital or the voting right. All right, so remember these points. Voting rights is capped at 10%, but if more than 5%, RBI's approval is required. There is no ceiling on the shareholding, but if more than 5% of the paid up capital, then RBI's approval is required, right? And it can be increased to 26%. Okay, How can we acquire the share by transfer on behalf of a minor? Like this, the shares can be acquired. Okay. Then RBI can also restrict the transferees' voting rights if they are more than 5% without approval. So if A already had voting rights of, let's say, 2%, B transferred their rights to A, making it 5%, and this was done without approval of RBI. RBI can take action on it. That is why it is important that the banking company they make a reporting to RBI about the shares which are held by the chairperson, the managing director, CEO. These details have to be reported to RBI from time to time. Okay, reports have to be sent, right? And this report will contain the full particulars, the value of shares held directly or indirectly, any change in the extent of holding, any other information. Now, on these shares, the banks can also declare commission, brokerage, or discount, but the payment on this account in any form should not exceed 2.5% of its issue price. The commission, brokerage, or the discount should not be more than 2.5% of the price at which the shares are issued. Earlier, this commission it was linked to not the issue price but to the paid up value of the shares. Earlier, it was linked to the paid up value of the shares. Now, it is linked to the issue price of the shares, not more than 2.5% of the issue price. Similarly, if the bank wants to pay dividend as per the RBI rules, before declaring dividend, certain requirements have to be fulfilled. First, the proposed dividend will be payable out of the current year's net profit only. Out of the current year's net profit only. And when they're declaring the dividend, CRAR should be at least 9% or more than that in the preceding 2 years plus current year. Okay, the CRAR for the preceding two completing years and the accounting year for which they are declaring the dividend should be at least 9%, and the net NPA should be less than 7%. Okay, the net NPA should be less than 7%. Now, let's say the bank does not meet this CRAR norm. They're having at least 9% CRAR, if not more than that, but their net NPA is less than 5%. Then also they will be allowed to declare the dividend. All right. So these 2 points are there. Either more than 9% CRAR, net NPA less than 7, or if at least 9% CRAR and net NPA is less than 5%. Then also the dividends can be declared. All right. And then the compliance with the capitalized expenses. All the capitalized expenses should be written off. Only then the dividends can be declared. And the dividend payout ratio should be less than or not exceeding 40%. Right? 40%. The dividend payout ratio will not be more than 40%. So these are the dividend rules. Banks can declare the commission, brokerage, they can declare the dividends, but first they have to follow these things. Then subsidiaries of the banking companies, there are certain restrictions as per the Banking Regulation Act on the formation of the subsidiaries as well. This basically is done to prevent the bank from carrying on any trading activities or acquiring a controlling interest in the bank non-banking companies, right? So subsidiaries will be permitted only for the permitted business, right? It will not be allowed for carrying on any business, any trading business exclusively outside India. Prior permission of RBI is required for any business exclusively outside India, and any other business, if allowed with the prior approval of central government, then also RBI's permission is required, right? So this is the subsidiary, the purpose for which the subsidiaries can be set up. Can the banks have shareholding in other companies? Yes, but there is a ceiling. There's a ceiling on the shareholding in the companies other than the subsidiaries. Obviously, in the subsidiaries, they will have the maximum shareholding. Other than that, the holding of shares in a company, let's say as a pledgee or a mortgagee or an absolute owner, it should not increase, it should not be more than 30% of the company's paid up capital or the bank's paid up capital and reserve. So, Bank ABC. ABC Bank is having the shareholding in any company, let's say X firm. There they cannot have more than 30% of the paid up capital reserves, right? Also, banks are not allowed to hold shares in a company where the managing director has a substantial interest. Let's say the managing director is owning the company or the relatives are owning the company. There, the banks cannot hold shares. All right. So, associate enterprises, joint ventures, subsidiary company, all of these are allowed, but there are restrictions over it as per the Banking Regulation Act. All right. Next, we have the board of directors. How the board of directors are formed, what are the qualifications, the period of office. So, if we talk about the qualification, again in the Banking Regulation Act, certain qualification, fit and proper criteria is to be fulfilled. At least 51% of the directors should have special knowledge or experience in the fields like banking, law, economics, agriculture, finance, etc. So, the 51% of the total directors on the board of the banking company should have special knowledge or experience. And then at least two should have special knowledge or expertise in agriculture, rural economy, corporations, or the small sector industry. Very important point. At least 51% should have special knowledge or practical experience with respect to banking, and at least two should have special knowledge or experience in agriculture, rural economy, or cooperation or small scale industry. Right? Now, can any person who has a substantial interest in a trading concern be a director of the banking company? No, right? So the directors of the banking company will not have a substantial interest. They should not be connected as an employee, manager, or a managing agent in a company which is carrying on trade, commerce, or industry. All right, obviously, there are exceptions, except the small sector industries. If they're acting as an employee or a manager of the small sector industry, then they are allowed. Otherwise, not. Similarly, if they're holding substantial interest, not allowed. What is substantial interest? If a person has beneficial shareholding of more than 5 lakh rupees or more than 10% of the capital of a trading concern, of a trading company, that person cannot hold the position of a director in the banking company. What is the tenure? What is the period of office for the directors on the board? They will hold office not more than 8 years. This question was asked in the June cycle. What is the tenure for the directors in a banking company? 8 years. All right. However, it is not applicable to the chairperson or a whole-time director. When the chairperson or the whole-time director is removed, now they cease to be a director of the bank and they are no longer eligible for appointment as a director for a period of 4 years. Right? This is the exception. If a chairperson or a whole-time director is removed, now for 4 years they become ineligible for reappointment. Okay, RBI, if they order to remove such a whole-time director or a chairperson, there will be a vacancy. RBI will reconstitute the board, right? Or if any time a director is to be retired, or if RBI thinks that the banking company's board does not fulfill the requirement, then RBI can appoint a new director in the place of the person removed. And they will continue to hold office till the original person, the previous person would have held their office, right? And any proceeding, any act done by the banking company or the director in good faith will not be questioned, it will not be held invalid. These are the requirements for the director of the banking company. Then the chairperson of the banking company. Chairperson can be on a whole time basis, full time basis, or a part time chairperson or a managing director. So, apart from the directors, the banking company will have a whole time or part time, and they will be appointed from the directors itself, from among its directors. So, appointed on a whole time basis, they will be interested with the entire affairs of the company, all the affairs they will be involved in. If a chairperson is appointed on a part-time basis, it will be with the prior approval of RBI, and whatever conditions are imposed while granting the approval, they will have to follow. If, let's say, what is the role of the managing director? When the chairperson is absent for any reason, or the whole time chairperson is absent for any reason, the managing director will now conduct all of its affairs. Okay, the management is entrusted to the MD in the absence of the whole time or the part time chairperson, right? What is the tenure? They will hold office for maximum 5 years and they are eligible for reappointment. Directors are for 8 years. These chairperson MD, they are for 5 years. Their period of office is for 5 years, right? Qualifications, they should have special knowledge, expertise in banking industry, right? Working of a banking company, SBI, subsidiary bank. Okay, there are certain restrictions on their appointment as well, certain disqualification. When will a person be disqualified for being a chairperson? If they are a director of any company other than the banking company, right? If they are acting as a director of any other company under this company for which we are talking about, or they are a partner in a trading concern, they have a substantial interest, more than 10% of the capital of any other trading company. If they're a director, manager, managing agent, partner of a commercial concern, or they're engaged in any other business or vocation. So such person will not be eligible to be appointed as a chairperson. Whole time, part time, MD, nothing. Now, RBI has the power to remove the chairperson if they do not fulfill the fit and proper criteria. So the bank, they appointed from among its directors a chairperson. But according to RBI, they do not fulfill the fit and proper criteria. They do not have prior experience or expertise or knowledge, or they have substantial interest in any other company, or they have been involved in corruption or any action of criminal nature. RBI will give the reasons in writing, an opportunity of being heard, and then they will remove the person. Now, when such person is removed, a new director has to be appointed within 2 months. If RBI says that the bank is unable to appoint this person, RBI will appoint it on their behalf, a suitable person in her or his place, whoever is removed, right? And they will also hold office for the residual period, whatever was left for the previous chairperson. Okay, again, they also have the right to make an appeal to the central government within 30 days, right? Okay. Then, if there is any temporary vacancy, let's say the chairperson, the MD, they die or they resign or they are incapable of discharging their functions due to illness or any other thing, then what will happen? The bank can appoint the managing director to act in their place or any other person on a temporary basis, but with the approval of RBI, right? With the approval of RBI, and it will not be for a period of more than 4 years. And if RBI is appointing someone, RBI also has the power to appoint a chairperson. This will be not for a period of more than 3 years. Okay. In certain cases, the office of the whole time chairperson or the MD may fall vacant, and it is not filled up by the bank immediately, it might affect the interest of the banking company or the depositors. So if RBI is of the opinion that if this vacancy continues, it will be against the interest of the banking company or the depositors, RBI may appoint an eligible person to fill such vacancy. Okay, and this will be not for a period of more than 3 years, a period not exceeding 3 years. And after the initial period, they can also be reappointed, right? Then, do they need to hold any qualification share? No. The whole time chairperson or the MD of the banking company is exempted from the requirement of holding any qualification shares. Okay, then RBI has certain powers which have overriding provision over the Banking Regulation Act, and there is also the Financial Services Institutions Bureau. Now, when RBI has to appoint a chairperson or a whole time director or a managing director, and every time they have to conduct a scrutiny, it will be a tiresome job, it will take a lot of time. So the FSIB, which was created in 2022, the purpose of this creation was to recommend persons who can be appointed as the whole time directors or the non executive chairpersons on the board of the banks, right? Earlier there was the Banks Board Bureau, the Banks Board Bureau that was doing this function. Now the FSIB, the Financial Services Institution Bureau, will recommend persons for the appointment. Okay. Banking companies, other than these directors, can also appoint additional directors if required, and they need prior approval of RBI. So, RBI, if they are of the opinion that it is in the interest of the banking policy or the public interest that additional directors should be appointed to the banking company, then they will allow it. They will hold office during the pleasure of RBI and not exceeding 3 years at a point of time. It can be extended and they are reappointed. So let's say they're appointed, it will be for 3 years. After 3 years, RBI can extend their appointment for another 3 years. And if they're acting as a director, they do anything in good faith, they will hold no liability for any of the action, and they're also not required to hold any qualification shares. All right, and this is also a very important point. When such additional directors are appointed, it will not be included in the total number of directors of the banking company. Any additional director which is appointed will not be taken into account in the total number of directors of the banking company. All right, so remember the tenor. They will have no liability for good faith action. Qualification shares are not required for the additional directors, and it is not included in the total number of directors. There are certain restrictions on employment, like a person who has been adjudicated insolvent, they have been suspended, cannot be appointed as managing agent or the directors. A person who has been convicted by a criminal court, they have been involved in corruption, again, they are disqualified. A person who is getting remuneration which is more than what is stipulated by RBI, they are restricted, right? Again, RBI will consider the financial condition, the area of operation, and then certain restrictions will be imposed. And persons who are directors of any company other than the subsidiary company, we have already studied, they cannot be a director in the banking company, right? This applies to workman, management personnel, everything, right? Directors of other companies are prohibited from managing the bank. Directors, if such person is a director of the subsidiary of the banking company, then it is allowed. Otherwise, if they are director of any other company, not allowed. Temporary exemption can be 3 months if some person is appointed due to some genuine reason. Maximum 3 months or extended by RBI for not more than 9 months. right? And the office tenure will be not more than 5 years. They can be reappointed, but not more than 5 years. Okay. Then RBI has the control over management. RBI has the power to remove the management. RBI can remove any chairperson, any director, any CEO, officer, employee of the banking company. Obviously, it will be done if the removal is in public interest, or the banking company is carrying out anything which is detrimental to the interest of the depositors, or RBI thinks it is necessary for the proper management of the banking company. They will give the reasons in writing. They will give a reasonable opportunity to the person being removed to make a representation, and then the person will be removed. When such person is removed, they will not be entitled to any compensation for loss of office. Right? Again, they have the right to make an appeal to the central government within 30 days of such decision, and the decision of the central government will be final. Final means now it cannot be challenged in any civil court, high court, supreme court, nowhere, right? What will be the effect of the order of removal? The person will now cease to hold office. They are also prohibited from taking part in the management of any banking company for 5 years. So when such person is removed from their office by RBI, they cannot be involved in the management of any banking company for 5 years. And if they are appointed, then penalty will be imposed, rupees 250 per day for the contravention. All right. So this is the effect of removal. Then RBI will appoint another person in their place. Such person will be appointed for a period not exceeding 3 years at a time. Okay. RBI can also supersede the board of directors. Let's say RBI thinks that the bank is not able to carry on the banking business, the directors are not able to take the correct decision, then for a period of 6 months, it can be extended further to 12 months. RBI can appoint their own administrator in the board of directors. This administrator will be assisted by a committee, three or more persons again constituted with RBI in consultation with the central government. And once the proper constitution of the board is done, then the administrator will vacate their office. Last topic, corporate governance. Basically, if you remember, we have studied about the OECD, the Organization for Economic Cooperation and Development. What is the meaning of corporate governance? In every banking company, there should be an environment of trust, transparency, accountability. There should be financial stability and business integrity. Each and every person should support for the growth of the banking company to create inclusive society. So this is the meaning of corporate governance. So the OECD principles are these. For the corporate governance and banks, RBI has announced certain things, like there will be advisory groups in the bank, the fit and proper criteria for the directors, as we have already discussed, their experience and expertise, the ownership limits are there, corporate entities, the financial entities, banks and financial institutions cannot hold more than 5% stake in another bank. In industrial houses, not more than 10%. Higher shareholding if in reconstruction or consolidation cases. Otherwise, not. So these are the corporate governance rules as directed by the RBI. For the directors and governance also, the responsibilities of the directors should be clearly defined. Their training should be conducted. Not more than one member should be on the board of a family member should be on the board of the banking company. The declaration and undertaking of the fit and proper criteria. The CEO, MD, whole-time director should meet the fit and proper criteria. Once they have completed their 8 year period or their 5 year period, 3 years cooling off time is given before reappointment. Age limit 70 years. Banks, according to their internal policy, can set a lower limit. And major promoter or shareholder maximum 12 years. Okay, so this is the director and corporate governance rules. All right, so these things have been stipulated by RBI. Basically, the MD, CEO, who is also a promoter or a major shareholder, they cannot hold these posts for more than 12 years. In extraordinary circumstances, at the sole discretion of RBI, this can be extended to 15 years. All right. So that is all about our unit 2. Before we start with our unit 3, again, if you have any doubts, any queries, please ask. Any questions, any topic that you don't understand, you can ask. Everything is clear? Okay. Then the unit 3, which is the regulation of banking business. Again, RBI has the powers to regulate the banking business, accepting of deposits, giving of loans, any other things, RBI will regulate it, monitor it, right? So there are certain sections like section 21, which gives powers to regulate the loans extended by the banking companies, and section 35A, which says the powers to generally regulate the banking companies in general, regulating the rate of interest, the other terms and conditions, the deposits, loans, and advances. All of these powers are there with RBI under the section 21 and section 35. Then there were certain amendments which were made. The section 35AA and 35AB were also issued. So RBI can intervene in the recovery of loans, settling the bad loans. What is the nature of these directions? Doesn't matter if RBI separately stipulates whether it is a statutory instruction or not. All the directions that are issued by RBI will be statutory and binding on the banks. Banks, they have to comply with the directions. Okay, they have to comply with the directions. Then let us talk about the various business of the bank one by one. When we are talking about the acceptance of deposits, what are the types of deposits? Demand deposits, term deposits, recurring deposit, the two-in-one combination deposits, all of these can be accepted by banks. They have to fulfill the KYC norm. There are different norms for the NRI deposit. The customers which are covered under the DICGC administered by RBI, all of these things have to be fulfilled. Okay, the term agreed between the depositor and the bank. RBI regulates the moratoriums, the minimum and maximum deposit period. Like a term deposit can be created minimum for 7 days or 15 days, depending upon the deposit. 15 lakh, more than 15 lakh, less than 15 lakh. Maximum, it can be created for 10 years, or it can be extended further for more than that years in exceptional cases, right? All of these things are stipulated by RBI. Then there is the DICGC, that all the banks, RRBs, cooperative banks, they are now under the purview of the Deposit Insurance and Credit Guarantee Corporation. It is administered by RBI. So all the funds up to 5 lakhs are returnable by a bank to the account holder. If the bank comes into moratorium, if there are certain restrictions imposed by RBI, then within 90 days of such action, they have to return coverage up to 5 lakh rupees per depositor, right? Banks are also required to file a return every year on their unclaimed deposit. Let's say a deposit was to mature in 2025, but it was not claimed by anyone. The return has to be filed. Calendar year, by within 30 days of the end of the each calendar year, the bank has to report a file. The return will be reported to RBI, and then it will be transferred to the DEAF. What happens here? The period of 10 years, right? For the period of 10 years. If it remains unclaimed, inoperative, the account is not operated for a period of 10 years or more, then it will be transferred to the DEAF, the Depositor Education and Awareness Fund. So remember, this return has to be filed each year at the end of each calendar year. Okay, all the types of deposits: savings deposit, the fixed deposit, cumulative, cash credit account, loan account, everything. The rate of interest, earlier it was controlled by RBI, but now the discretion is with the banks. Then we have the nomination facility. The depositors of a banking company, they can nominate one person, now up to four persons can be nominated. They have the right of the original depositor on the death of the original depositor. This nomination can be varied or cancelled at any time. If the nominee is a minor, then the person who will receive the deposit amount on the death of the depositor on behalf of the minor will also be appointed. Okay, so these are the nomination rules. Then the articles which are kept in safe custody, again, nominees can be appointed for that. On the death of the locker hirer, how the articles will be returned to the nominee or the legal hires, it should be with proper due care and caution. Okay, then this is important. The loans and advances. RBI regulates the lending as per the section 21. There is the selective credit control provision. RBI gives directions to the banks that which type of loans should be restricted, should be limited. This is basically so that the banks, they are not undertaking too much risk, or they're not concentrating their loans and advances to one particular segment only, right? So RBI issues directions in public interest, the purpose for which the advances may or may not be made, the margins to be maintained, the maximum amount of advances, the maximum amount up to which guarantees may be given by the banking company, the rate of interest, how it is to be determined. All of these directions are given by RBI. Okay, then the banks, they cannot give loans against their own shares as security. Banks cannot give loans to directors, firms, or companies where the directors have substantial interest, where the director is a guarantor or a partner. And RBI's permission is required if the bank is remitting a director's debt. There also RBI's permission is required. And if any of these rules or regulations are contravened, then such directions will be void. It will not be termed as a valid contract. Okay. Now, how does RBI regulate the interest rate on the loans? RBI regulates the interest on deposits. How? By stipulating the minimum and the maximum, not controlling, not telling the exact number. It depends. The banks, they have the autonomy. They are free to decide their deposits, but as per the range stipulated by RBI. Okay, interest rate on the loans and advances is important. So for the scheduled commercial banks, SFBs, differential rate is allowed for deposits of more than 2 crores. For the RRBs, differential rate for deposit of more than 15 lakh. So up to this limit, uniform rate of interest should be offered. More than that, if a deposit is created, the banks can offer a differential rate of interest on the deposit. Now, if we talk about the interest on loans and advances, Section 21 is there, Section 35A is there. Earlier, we had the BPLR system, right, which was introduced in 2003. But it fell short of the original objective of bringing transparency. Why? Because the banks were allowed to lend below the BPLR, right? They were allowed to lend below the BPLR. Thus, the BPLR system was replaced by the base rate to bring more transparency. When in 2010, it replaced the BPLR system. Base rate includes all the elements of the lending rate, common across all the categories of borrowers. Banks can choose their own benchmark. They can determine the actual lending rates. In order to give more the banks more times to stabilize, a 6-month period was given by RBI. Again, the base rate system was replaced by the MCLR in 2016. The marginal cost of fund based lending rate. What is the difference between base rate and MCLR? MCLR is determined by the current cost of fund. Base rate was governed by the average cost of fund. MCLR, it is calculated using the tenor premium, the time period for which the loan is given. Base rate calculates the minimum rate of return or the profit margin. Base rate, it takes into account the operating expenses, the expenses needed to maintain the CRR. MCLR, they consider the deposit rate, repo rate, as well as the operating cost. So MCLR takes into account the repo rate. Base rate did not include the repo rate. These are the differences between base rate and MCLR. So what is the marginal cost of fund based lending rate? The banks, they cannot grant below this rate. It serves as the benchmark. The structure and methodology, it includes the marginal cost of fund, the negative carry on account of CRR, the operating cost, and the tenor premium. Banks, they can publish the internal benchmark, the overnight MCLR, 1 month MCLR, 3 month MCLR, even more than that. Okay. Again, the MCLR was also replaced by the external benchmark lending when in 2019. So, what is the external benchmark based lending? All the new floating rate personal or retail loans or floating rate loans to the MSME, they will be now linked to the external benchmark, right? What can be the external benchmark? They can be linked to the RBI repo rate or the Government of India Treasury Bill, which is published by the FBIL, 3 month Treasury Bill, 6 month Treasury Bill, whatever. Banks can offer the external benchmark to other type of borrowers other than retail or MSME also, right? So this is how the external benchmark works, right? It has to be reset at least once in 3 months. It will be reset at least once in 3 months. Now, earlier there was an act. The act was Usurious Loans Act of 1913. 1918. This act was of the British era, basically to protect the public from very high interest rate on the loans, right? To protect the weak borrowers from powerful money lenders, right? To protect the agriculturalist from the money lenders, to protect the borrowers from going into a debt trap. However, now the public, the borrowers, they approached the courts saying that the banks are charging a very high rate of interest. It was interfering in the bank business. So now these cases cannot be opened in the courts as per the section 21A of the Banking Regulation Act. So the section 21A of the Banking Regulation Act overrides the Usurious Loans Act of 1918. So, if the rate of interest which is determined by the bank is in line with RBI rules, then no borrower can question it, they cannot take it to the court. No court will open such cases. Okay. So these are the guidelines for the loans and deposit interest rate. Then internet banking guidelines are also issued by RBI. The technology and security issues, the legal issues, the regulatory and supervisory issues. Whenever the banks are offering internet banking, these guidelines they have to follow, right? Like the technology and security standard, they should have a security policy. The information system auditor should be there. The public key infrastructure that they are using, physical access control should be there. Legal issues can should be there. The Consumer Protection Act, the consumer should be aware about their rights and how they should use the internet facility. Okay, now the internet banking, There should be a RBI approval required before banks they offer the internet banking facility. Banks are also required to report the breaches to the RBI, and only the clearing system, those banks which are members of clearing system, only they are allowed to act in the interbank gateways, right? There are two types of internet banking facility. It can be view only facility, where for the non-transactional services the website is used for balance inquiry, viewing the balance, account statement download, request for supply of the checkbook. Fund based transaction is not there. Okay, so this is the view only facility. The transactional facility, where through internet the fund based operations are allowed. There are certain requirements like the CRAR should be more than 10%. RBI approval is required. CRAR should be more than 10%. Net worth should be more than 50 crore rupees, or the gross NPA should be less than 7%. Net NPA should be less than 3%. They should have a good track record, profit track record. They should fulfill the CRR and the SLR compliance, and a sound governance should be there. All right, a good track record of the regulatory compliance. No monetary penalty has been imposed on the violation of the RBI direction. They should not have defaulted in maintenance of the CRR during the immediate preceding financial year. They should have made a net profit in the preceding financial year. Gross NPA is less than 7%, net NPA not more than 3%, net worth rupees 50 crores, CRAR not less than 10%. All right. So these are the things to be followed if the banks want to offer the transactional facility through internet. Then RBI also regulates the money market instruments. RBI empowers in public interest to regulate the financial system. The policy related to the banks when they're participating, when they're dealing in the foreign exchange, derivatives, stocks, shares, anything. Who all can participate? Scheduled commercial banks, payment banks, SFBs, RRBs. There are certain prudential limits which are stipulated. You need not remember them. Okay. The participants you should remember. Local area banks not allowed. Scheduled commercial banks are allowed, but local area banks are not allowed. Certificate of deposit. Who can issue the certificate of deposit? Scheduled commercial banks, RRBs, SFBs, and All India Financial Institution. Right? They are allowed to issue the certificate of deposit in the dematerialized format, discounted instrument, and all persons resident in India are allowed to invest, right? They should be held with a depository. Minimum denomination of rupees 5 lakhs, multiples thereof 10 lakh, 15 lakh, 20 lakh. Minimum tenor should be 7 days, maximum 1 year. So, what is the tenor of the certificates of deposits issued by the banks? 7 days to 1 year, and they are issued on a T plus 1 day basis. Banks are, however, not allowed to grant loans against their certificate of deposit, right? And how will the buyback be done? It can be done only after more than 7 days after the issue, right? So these are the features of the certificate of deposit issued by the banks. Banks are also allowed to issue the commercial papers. Okay, then the eligible investors, resident, non-resident, they will be allowed to invest in the commercial papers. Then we have the banking ombudsman scheme. Now we have the integrated ombudsman scheme, the RBI integrated ombudsman scheme. Earlier we had separate ombudsman for the banking system, the banking ombudsman scheme of 1965 by the RBI. We had the ombudsman scheme for the NBFCs, and we had the ombudsman scheme for the digital transactions. Separate they were there. Now they have been merged into the RBI ombudsman scheme of 2021. Okay. The Banking Ombudsman Scheme powers were given by the Banking Regulation Act. Then the Ombudsman Scheme for NBFCs under the RBI Act, and the Ombudsman Scheme for Digital Transactions under the Payment and Settlement Systems Act. Now it is no longer necessary for the complainant to identify under which scheme she will file the complaint. The deficiency in service has been clearly defined. The responsibility of representing the regulated entity is of the principal nodal officer, who will be of the rank of a general manager in the public sector bank, right? And there is the appellate authority as well. Appellate authority, the CEPD. Okay. The executive director in charge of the Consumer Education and Protection Department of RBI will be the appellate authority. So all of these points are there for the integrated ombudsman scheme, right? Then for filing such complaints, there is the Limitation Act. The award will be binding only if. Now there's the whole process. We'll be studying about it in detail in our module C. What happens? When the customer faces a deficiency in service, first they will apply to the bank. If they don't get a response within 30 days, they can apply to the ombudsman. The ombudsman will solve it within 60 days. When they pass an order, they first, the ombudsman, when they receive the complaint, they will issue notice to the regulated entity to furnish the document. The regulated entity has to furnish the document. After hearing both the parties, the ombudsman will pass the award. When the award is passed, it has to be accepted by the complainant within 15 days, and then within 1 month of the acceptance, the bank has to comply, do whatever has been stipulated by the ombudsman in the award. There's the right to appeal. The complainant can make the appeal to the appellate authority, right? And the regulated entity can also make an appeal, but only if they had furnished the documents to RBI. On non-furnishing, this will be ex parte decision. Then the appeal cannot be made by the regulated entity. Right? We'll be studying about it in detail, don't worry, in our module C. Now, RBI's role is also to ensure financial stability. So, financial stability, RBI has defined as where the financial sector provides the critical services without any discontinuity. For that, RBI has set up certain rules like maintenance of the reserve fund. Okay, a reserve fund has to be maintained by the banking company as per the section 17 of the Banking Regulation Act. This reserve fund is maintained out of the profits shown in their profit and loss account every year. Every year, a sum equivalent to not less than 25%, at minimum 25% or more than that, of the net profit before declaring dividend, they have to transfer to this reserve fund that they maintain. Okay. And if they want to appropriate anything from the reserve fund in an emergency, they need to report it to RBI within 21 days of the appropriation. Appropriation means if they want to withdraw something of this reserve fund. So remember, 25% of the net profit, it has to be maintained. Every year it will be transferred to the reserve fund before declaring the dividend. Any appropriation, if it is made, then within 21 days, reporting has to be done from to RBI. Then, if we are talking about the foreign banks, they are not required to create a reserve fund, but they will have to maintain a deposit with RBI. So they need to deposit and keep deposited at all times with RBI an amount which will be 20% of their annual profits. This can be maintained in cash or unencumbered approved security, whatever, as stipulated by the RBI. Then there also the banks are required to maintain the CRR and the SLR. They also need to report it. So the scheduled banks under section 42, they have to maintain the CRR, right? The scheduled bank is included in the second schedule of the RBI Act. Okay, they are required under the section 42 to maintain the CRR. The non-scheduled banks under section 18 of the Banking Regulation Act, they have to maintain the cash reserve. Scheduled banks are what? They're included in the second schedule of RBI if they have a paid up capital and reserve of not less than rupees 5 lakh, if they're not conducting any activity detrimental to the interest of the depositors, right? Then they will be included in the second schedule. What is the benefit? They can get loans from RBI. What is the quantum of cash reserve? Earlier, the cash reserve was very high. Now it has been brought down. So the cash reserve required to be maintained by a scheduled bank is an average of the daily balance, right? Such percentage of the total demand and time liabilities in India. Okay, how do we determine the CRR? It is determined by RBI as per the ceiling or the floor rate, right? Average daily balance means the average of the balances held at the close of business of each day. Okay, so that is the meaning of CRR. Then the maintenance of CRR also has to be reported to RBI. Form A is the return filed by the scheduled commercial banks, excluding the including the RRBs, SFBs, payment banks, and the local area banks. So these banks they need to use the form A to submit the return on their CRR. Form B is to be filled by the scheduled cooperative banks, and Form I is for the non-scheduled cooperative banks. RBI does not pay any interest on the CRR balances. Okay, RBI will not pay any interest, right? Returns have to be filed, we have already said. If there is a default in maintaining the CRR balances, then penalties will be imposed. When the balance maintained falls below the stipulated minimum, then such a bank will be liable to pay a penalty to the RBI. During the first fortnight, when the shortage occurs, the penalty will be three times above the bank rate. And if it continues for the next fortnight, it will be increased to 5% above the bank rate, right? So for the first fortnight, 3% above the bank rate. For the next fortnight, 5% above the bank rate. And if it still continues, then every director, secretary, manager who knowingly was involved in the default or non-maintenance of the CRR will also be punishable with a fine. Okay, then RBI can prohibit the banking company from accepting fresh deposit apart from the fines, right? And it has to be paid within 14 days of the notice demanding payment. Okay, similarly for the non-scheduled banks also same thing has to be followed. Then if we talk about the maintenance of SLR, the statutory liquidity ratio, so a certain percentage of their net demand and time liabilities in India, whatever assets they have, the banks have in India, as per the Banking Regulation Act, they need to maintain the SLR, right? So CRR has to be maintained with RBI. SLR, the banks have to maintain with themselves. Okay. So again, SLR is stipulated by RBI, not exceeding 40% of the total demand and time liabilities on the last Friday. Returns have to be filed monthly. The return has to be submitted not later than 20 days from the end of the month to which it relates. So if it was for the month of November, by 20 December, the returns have to be filed. Okay. Here again, two forms are there. Form 8, which will be filed by the scheduled commercial banks, including the RRBs, SFBs, payment banks, and LABs. Form I will be submitted by the cooperative bank. There's also a penalty on the default if the balance maintained falls below than the minimum requirement. Liability to pay on the banking company will be 3% above the bank rate for the shortfall for the day, right? For every day. If it continues for succeeding Friday, then the penalty will be raised to 5%. So it is same. And if it still continues, then every director, manager, secretary responsible will also be liable to pay a fine. Now, in both the cases, non-maintenance of CRR, non-maintenance of SLR, if this manager, secretary, they're able to prove that they were not involved in the contravention, that they had no idea, or they had tried their best to maintain, then they can be exempted from the penalty. Otherwise, not. All right. So that is the maintenance of CRR SLR. Now, quarterly position of assets also, every the assets of in India of every banking company, they also need to be reported to RBI. It will not be less than 75% of its demand and time liabilities. And within 1 month from the end of every quarter, this return has to be submitted to RBI about the assets and liabilities that they hold in India. The regional rural banks, they will report their compliance to NABARD. Okay, banks they reported to RBI, right? But the RRBs they reported to NABARD. When the reporting has to be done within 1 month from the end of every quarter, the report has to be submitted. And that is all about the unit 3, right? So we have completed our unit 3. Again, if you have any doubts, any queries, please ask. I know we are going fast because we are revising the provisions and module A is completely theoretical. Okay, that is why these notes are crisp. Once the session is over, just download the PDF, go through it, revise the PDF, right? Next, we have the unit 4, which is the returns, inspection, winding up, mergers, and acquisition. Banks, they are required, the banking companies, they prepare their balance sheet and accounts annually. These have to be audited by the duly qualified auditors. The balance sheet accounts, they have to be submitted as returns to RBI. Copies also have to be submitted to the ROC, to the government also sometimes, the central government. They also require the copies to be sent to them, right? So the annual accounts and balance sheet, all the banks who have their shares listed with the stock exchanges, they need to publish their unaudited quarterly results as per the format prescribed by SEBI, right? So whatever format is prescribed by SEBI, they will prepare their unaudited quarterly returns results, and this has to be prepared, the balance sheet and profit loss account has to be prepared at the end of each calendar year. Okay, it will cover their entire business in India. In case of the foreign banks, only in India. In case of a bank, Indian bank that has their business outside, they need to include that also, right? Then the balance sheet and profit and loss account, it will be signed, again very important, signatures. In case of the Indian bank, the public sector banks in India, the balance sheet and profit and loss account has to be signed by a manager or the principal officer of the company, and at least three directors if there are more than three directors. And if there are less than three directors, all the directors will sign it. In case of the foreign bank, the manager or the agent of the principal office in India, the manager or the agent will sign it. Then the profit and loss account, the balance sheet will be prepared as per the Banking Regulation Act, and it overrides the Companies Act. If, let's say, anything is given in the Companies Act which is in contravention to the Banking Regulation Act, then we will follow the Companies Act, right? If it is not inconsistent, anything can be followed. But if it is different, then the Banking Regulation Act will override the Companies Act, right? Central government is empowered to amend the form. In case of the banking companies, the profit and loss account will also be placed before the annual general meeting, right? And they will discuss over it. SEBI listing agreement, the listed companies' unaudited financial results on a quarterly basis. They need to submit it. Also, they need to publish in a newspaper within 6 months. All the banks, they need to publish in a newspaper which is in wide circulation at the place where the banking company has its principal office within a period of 6 months from the end of the period to which the account relates. Okay. And banks who have their shares listed on the capital market, unaudited quarterly results have to be published as prescribed by SEBI. Then submission is to be done to the Reserve Bank. 3 copies of the returns they need to submit to RBI within 3 months, and 3 copies they also need to send to the registrar of the companies. However, furnishing to the registrar, the Banking Regulation Act provides. Company Act says that the balance sheet along with the auditor's report to the registrar of companies, it is required. In the case of banking companies, in the Banking Regulation Act also, the 3 copies of the account, balance sheet, and auditor's report submitted to RBI have to be submitted. 3 copies. And the balance sheet, account, if we talk about the foreign banks, they also need to display it in a conspicuous place in the principal office of their last audited balance sheet, right? So these are the requirement. Then if we talk about the audit or the auditors, every banking company should have a duly qualified auditor. So, when the balance sheet, the profit and loss account is prepared, it will be audited by a person duly qualified, and such person will certify that each and everything given in the balance sheet, the profit and loss account, is a true picture. Nothing misleading is there, any omission is not there, whether the information and explanation is satisfactory, whether all the transactions in the company, they are within the powers of the company or not, whether the returns are adequate or not, does the profit and loss account show a true picture of the company or not. These things will be stipulated by the auditor. And if later on anything is found to be false, the auditor will also be equally responsible. RBI can impose penalty on them. RBI also has the power to conduct a special audit wherever the special audit is necessary in the public interest. Then RBI can order to conduct it. For this, the same auditor can conduct the audit, or RBI can appoint a different qualified auditor for the purpose. All the cost of the special audit will be borne by the banking company. Such orders are binding on the banking company, right? The auditor has to make a report to of the audit, send it to the RBI. Also, in case of the special audit, a copy will be given to the bank. The report of a special audit will be submitted to RBI. Copy will also be sent to the bank. Expenses of the auditor, the special audit, document, printing, whatever, is to be spent by the bank, right? Which returns have to be submitted by the banking company? They have to furnish several returns to RBI under the various provisions. Every banking company has to submit a return of its liquid asset within 20 days from the end of the month to which it relates. So if it relates to the month of December 2025, then by 20 January 2026, the return on liquid asset has to be sent to RBI, right? It will contain the information about the assets, the demand and time liabilities. The Reserve Bank can also ask the banking company to furnish any other information at the close of each day of the month. Monthly returns have to be submitted, right? Monthly returns on the asset and liabilities in India. Such return will be submitted before the close of the month succeeding to which it relates. So for the month of December, before the end of December. Okay. And RBI can call for statements and information at any time. RBI can also direct the banking company to submit the statement or information regarding the investment of the banking company. The account and balance sheet also has to be submitted to RBI within 3 months. So everything I've written, right? Liquid assets within 20 months of the month end, monthly return, assets and liabilities before the end of the month. Annual accounts have to be submitted within 3 months of the end of the period to which it relates. Returns of the assets in India, quarterly return within 1 month of the end of the quarter. Returns on the assets in India has to be submitted. Return also has to be filed on the unclaimed deposit calendar year. End of the calendar year, 30 days within the end of the calendar year on the unclaimed deposit. It will be submitted, it will be transferred to the Depositor Education and Awareness Fund maintained by RBI. Right? Those accounts which are not operated for 10 years will also be transferred here. And the depositor, the account holder, if they seek the deposit to be returned, the bank would be liable to make the payment with the necessary interest specified by RBI. Returns of cash reserve of the non-scheduled banks, monthly return has to be filed, and penalties, as we have already discussed, for the first fortnight 3% above the bank rate, next fortnight 5%. More than that, the directors, managers will also be responsible for it, right? Similarly, for the scheduled commercial banks, the various, sorry, for the SLR of the scheduled commercial banks, Form 1, the penalty for the shortfall we have already discussed in the previous unit. RBI can conduct the special audit, RBI can conduct the inspection and scrutiny. Special audit, already discussed. If RBI is of the opinion that the audit is necessary in the interest of the depositor, then the statutory auditor of the banking company itself or RBI can appoint another auditor. The cost will be borne by the banking company. Report will be sent to the banking company also. RBI conducts the annual financial inspection. It is the risk based supervision, the SPARK, right? Supervisory program on assessment of risk and capital. So, RBI conducts an inspection, it assesses all the types of risks under the risk based supervision. Inspection can be carried out if the direction is received from the central government. In such cases, a copy will be given to the banking company, right? And the officials of the banking company, they will be bound to produce all the books, accounts, documents that are in their custody. RBI can inspect any statement or information related to the affairs of the company. Central government can also order for an inspection of the banking company, and when such an inspection is ordered by the central government, copy will be sent to them mandatorily. Okay. In other types of inspection, if RBI wants, then they can send the copy to the central government. But if central government has directed to conduct the inspection, it is compulsory to send a copy to the central government. On the basis of the copy, the government can take any further action like prohibiting the bank from accepting deposit or giving loans depending upon the findings of the inspection. Obviously, before taking such action, an opportunity to the banking company to be heard will be given. RBI can also conduct the scrutiny. RBI can scrutinize the affairs of the banking company or the books of the banking company, particular transactions or a series of transactions, and adverse action can be taken against the banking company, right? Now, in case of inspection, it is important to give a copy to the banking company, but in case of the scrutiny, it is not mandatory for the RBI to provide a copy to the banking company. All right. Copy will be given only if requested. So, RBI, if it conducts the inspection, they will send a copy to the banking company. But in case of scrutiny, only if the banking company requests, then a copy will be given to them. Otherwise, it is not mandatory. Okay. So RBI has the power to call for books, accounts, documents, statement, information. They can also examine any director or officers of the banking company on oath. All the powers are the same. as an inspection. Then RBI, for the supervision of the commercial bank, has set up the board for financial supervision. Earlier we had the Department of Banking Supervision, right? So the Department of Banking Supervision was tasked with the inspection and surveillance function from 1993. Then in 1994, the Board of Financial Supervision was set up, covering all the scheduled commercial banks, cooperative banks, local area banks, NBFCs. Then this DBS was bifurcated into the Department of Banking Supervision, Department of Non-Banking Supervision, and the Department of Cooperative Supervision, right? Separately for the banks, NBFCs, and the cooperative banks. Okay. Then RBI has been now given powers under the amendment of 2019 to direct the NBFC to conduct their inspection. All right, so all of these things are there. What is the composition of the Board of Financial Supervision? Who all will be the member? Governor of the RBI will be the chairperson of the board. Four deputy governors of RBI will be there. One will be the vice chairperson. Deputy governor in charge of the supervision will also be there. Four directors from the Central Board of RBI nominated by the government will also be there. The BFS will also have a subcommittee, right? The subcommittee will exercise the powers of the supervision, inspection under the RBI Act. What is the function? To fine tune the supervisory function, introduce off-site surveillance, strengthen the statutory audit process, supervise the rating system, risk-based supervision, everything. This board will be required to meet normally once every month, and the quorum, at least the chairperson or the vice chairperson should be there. They will discuss on the inspection reports of the banks, the periodic reviews, the policy matters. There's also the Daksh. Daksh is the RBI's advanced supervisory system, monitoring system. So it is the online portal, web-based end-to-end application for off-site surveillance. RBI will monitor compliance requirement on an ongoing basis, anytime, anywhere, secure access. All right. So this is how the returns and inspections they work. Next part of this unit, we are going to talk about the acquisition of the undertakings by the government. So the central government can acquire the undertakings of the banking company. Undertaking would mean the entire organization. Like the nationalization was done, so when the central government acquires the undertakings of the banking company, what can be the reason? When the bank has failed to comply with the directions given to it, or the acquisition is necessary in the interest of the depositor, the bank is conducting anything which is detrimental to the banking policy, to the credit, to the depositors, it is necessary to acquire the undertakings of the banking company. Central government will do it in consultation with RBI, right? So when the central government acquires the banking company, all the assets, all the liabilities will now be acquired by the central government, or it can be given to the transferee bank. All right, the transferee bank. And from this point, the acquired bank will stand now what? It can be dissolved also, right? So who has the power to make scheme? The central government will prepare the scheme for any acquired bank. What will the scheme include? The scheme will include all the matters relating to the property, assets, liabilities, board of management, employees, their terms and conditions, payment of compensation to the shareholders. Central government can also modify or vary the scheme after consulting the RBI. How does the compensation to the shareholders is given? It is again determined by the central government. If any person is aggrieved by this compensation, they can make an appeal to a tribunal. A reference can be made to a tribunal. Okay. Then amalgamation of the banks can also be ordered by the central government. Voluntary amalgamation means when a banking company themselves apply to be amalgamated, right? For that, a scheme will be prepared. So two banks. two banks, A and B, they want to be amalgamated. They will together form a scheme for the amalgamation, and this scheme will be placed before the shareholders of both the companies separately. Approval of two-thirds of the shareholders from both the companies is required. So, two-thirds of company A shareholders will approve, two-thirds of company B shareholders will approve. Then the amalgamation will be done, right? The scheme will be approved by a resolution passed by the majority of members separately. Now, the shareholder who votes against the amalgamation, they have the right that if the banks are amalgamated, they have the right to take back the shares and leave. And from this point, when the amalgamation is done, then the amalgamated bank, let's say Bank A is being amalgamated into Bank B. Now, Bank A will stand dissolved. All right, Bank A will stand dissolved from the specified date. This is voluntary amalgamation when the banks themselves decide for the amalgamation. Central government is also empowered to order the amalgamation of two banking companies in consultation with RBI when, let's say, the bank is not able to conduct the banking function or they are acting in detriment. Now, when such temporary reason is there, the banks are temporarily unable to pay off the deposits or or maybe give out the loans, whatever. If temporarily they are unable to perform the banking function, they can apply for a moratorium, right? They can apply for a moratorium. So a moratorium for a period of 6 months will be given, right? During this moratorium, the banking company will not make any payment to the depositors, will not discharge any liability or obligation. They will just try to control whatever negative situation has happened. Now, if we talk about the scheme of amalgamation, which is prepared by the central government, the RBI can prepare the scheme, or the central government can prepare the scheme for the amalgamation or restructuring of the banking company if it is necessary in the public interest, in the interest of the depositors, for securing the proper management or for the banking system of the country as a whole. What will be included in this scheme? What is the constitution, capital, assets, rights, and obligations of the banking company, the amalgamated banking company, how the transfer of assets will be done to the transferee company in the case of amalgamation, the change or appointment of the board of directors, any alteration in the memorandum of or articles of association, reduction of the interest or rights of the members, any payment is to be done. Each and everything will be decided in the scheme prepared by RBI. So look at this point. The draft scheme is prepared by RBI. The central government sanctions it with modification. So when the RBI prepares the scheme, it is sent to the central government. The central government places it before the parliament, and when it is passed, then the amalgamation can be started. When what is the effect of sanction? It becomes binding on the banking company, the transferee bank, and the members, the depositors, creditors, employees, everyone. So, when the central government sanctions the scheme, it is now compulsory to follow whatever is given in the scheme. You cannot question it, right? A single scheme can also be prepared for more than one banks. And then we also have the winding up of the bank. What is the winding up? Winding up means shutting down of the bank, dissolution of the bank, liquidation of the bank, whatever term is used. So, if the banking company is unable to pay off its debts or the creditors, right, or they are unable to create loans, they are unable to meet any liabilities, it may result in the winding up of the bank. Okay, so the Banking Regulation Act provides a whole machinery for the proceedings in the liquidation of the banking company, right? So, suspension of the business and winding up. If, let's say, the banking company is temporarily unable to meet its obligation, they can apply to the High Court for staying the commencement or continuance of any proceeding against it, right? Whatever conditions are imposed by High Court. So during this moratorium, the winding up process will not start. If the bank says that it is only a temporary situation, if some time is given to us, we will continue with the banking operations as usual. Then moratorium can be given. This moratorium, if given by the High Court on sufficient reason, it should be supported by RBI. If not supported by RBI, if RBI is satisfied that the banking company under moratorium is doing anything which is detrimental to the interest of the depositors, they will apply to the High Court for the winding up. So if the High Court has ordered the moratorium, but RBI says that continuance of the banking company is wrong, it is causing harm to the banking public or the banking system, then it will become winding on the High Court to start the winding up process, and they cannot extend the period of moratorium. So RBI's decision is extremely important. Okay, right? So High Court can also order the winding up of a bank if the banking company is unable to pay its debts or application for the winding up has been made by RBI. Whenever RBI makes the application for winding up, they can do it on their own discretion, or if directed by the central government, then they have to make an application and they have to give the reasons in writing. If, in the opinion of the RBI, the bank, they are conducting their functions in detriment to the interest of the depositors, after giving an opportunity to be heard, the winding up process will be started, right? So if they fail to comply with the minimum capital requirement and reserves, or they are prohibited to accept any fresh deposit, they're not entitled to carry on the banking business, they fail to comply with the banking regulation requirement, any compromise or arrangement is not possible. The returns statements show that it cannot pay its debts, the continuance will cause harm to the depositors, then the High Court can also, or RBI or the government can apply for the winding up. All right. So these are the grounds. These are the grounds for the High Court. These are the grounds for the RBI to order the winding up of the banking company. Now, liquidator will be appointed. There's the official liquidator attached to every court, which can be appointed by the central government for the purpose of conducting all the proceedings of the winding up, or any other person, RBI or any other person like SBI or whatever notified by central government can also act as the official liquidator. What is the responsibility of the official liquidator? They will prepare an inventory of all the assets that can be sold for the recovery of the debts due to the depositors, right? So they will send a notice within 15 days of the winding up order. The official liquidator will give a notice calling for claims for the preferential payment from all the secured and unsecured creditor, right? The depositors, they need not make any claim. The depositors, they are automatically given a preference. Other than that, within 15 days, the notice has to be given. In the winding up process, the preferential treatment is given to those claims which are made under the Companies Act, right? Under the section 327 of the Companies Act, claims which are made within 1 month. So when the order of winding up is given, 15 days notice is served by the liquidator. Within 1 month, whoever submits their claim, they will get the first preference. After that, those depositors who have rupees 250 in their savings account, they will be paid off. Then the other depositors get priority over all the other creditors. Whatever balance is left will be utilized to make payment for the general creditors, and then anything else is left will again be paid off to the depositors. Okay. So this is how. Now in the Companies Act, when we were studying, or we will study in our module D, first the preferential payment is made to the liquidator for the cost. That does not happen in the case of the banking companies. First the depositors, they get the preferential treatment. Okay, those depositors which are covered under the DICGC Act, they get their payment as per the insurance policy. They are not covered here. Banks, they can apply for the voluntary winding up, but voluntary winding up will be allowed only if the RBI is satisfied that yes, the bank will not be able to pay in full its debts as they occur, right? The voluntary winding up, if the bank is just trying to run away with the money of the depositors, then RBI will not allow the voluntary winding up, and the bank cannot be dissolved unless and until they have paid off all its debts and dues. They have paid off all the deposits. Once they have completed their liabilities, only then they will be allowed to be wound up, otherwise not. Last topic of this unit, the penalties for the offences under the RBI Act and the Banking Regulation Act. If the bank fails to fulfill any of the direction as per the RBI Act, they fail to make applications, furnish return or statement, they any other regulation, order, direction, or they make a statement with a false information willfully, they will be imprisoned for a period of 3 years and a fine. Who will be imprisoned? The directors, the persons responsible. Even the auditors will be held liable. Okay, so if they fail to produce any books, account, document, they're punishable with a fine of up to rupees 1 lakh per offense. And if the offense is a continuing offense, then 5,000 rupees per day it will be imposed. This is as per the RBI Act, right? Any director or any person who can prove that they were not involved in the company's default will be left out of this penalty. Otherwise, they will be liable. This is the penalty under the RBI Act. Under the Banking Regulation Act, any false statement willfully made, any return, balance sheet, document which is wrongfully involved, then imprisonment up to 3 years and a fine that can be extended to 1 crore rupees or both. So, failure to produce any book, account, document, statement, or incorrect information is given. Fine can be up to 20 lakh rupees per offense. And continuing, if after receiving this order of paying the fine, they still continue in the offense, then 50,000 rupees for every day during which the offense continues. Right? If any deposits are received in contravention, every director of the banking company will also be deemed guilty, and they will be punishable for a fine that can be twice the deposit amount. Any other contravention up to 1 crore, twice the amount, 1 lakh rupees per day, right? All of these offenses are cognizable only by a metropolitan magistrate, a judicial first class, or a court superior on a complaint by an officer to the RBI, right? And Reserve Bank is empowered to impose a penalty for the default or contravention. All right. So with this, we have also completed our unit 4. Now we are left with 3 more units from our module A, but this we will continue tomorrow, right? This we are going to continue tomorrow. Tomorrow you will have your capsule lecture in the morning at 7 a.m. Okay, so tomorrow morning at 7 a.m. we will complete our module A, and then at 8 p.m. in the evening we will practice the questions. Okay, we will finish the remaining 3 units and we will also start with the module B. Then in the evening at 8 p.m. on YouTube we will be practicing the questions from module A. So I hope each and everything that we discussed today is clear. The notes that I've given you are very concise, only those points that you need to remember. So make sure that you go through it thoroughly, download the PDF, use it for your revision. Everyone who's joined here on the YouTube channel, you can join the capsule lecture by going on capsule batch by going on the Oliveboard website. And those who are here on the paid platform, please give me your feedback about the class. And now we will meet tomorrow at 7 a.m. So, shall we end the session? So, let us end the session now, everyone, and we will meet tomorrow morning, 7 a.m. Thank you, everyone, for attending. Good night, take care, and